Good day, participants. Today we would be talking about motor insurance. Motor insurance, which is on chapter number 8 of CFP2 module. Talking about motor insurance, it's the most popular form of insurance, and most of the people are aware of this kind of insurance because we have been flying our vehicles, we have been driving our vehicles, whether two-wheelers or four-wheelers. And a certain portion of this insurance is also compulsory by the government of India. Basically, motor vehicle insurance is divided into two kinds of insurance. One is called the liability insurance. It's famous as third-party liability. In common parlance, we call it third-party liability. And second insurance is a comprehensive insurance policy. Liability insurance policy covers any injury, death to the third party, a third person who can be injured or who can meet with death while we are flying the vehicle on the road, or damage to the property of third party. So damage to the property is also covered by this insurance, and this insurance is mandatory. We cannot drive our vehicle without this insurance. But this is, the second one is optional. Comprehensive means it does include this liability. Apart from this liability insurance, this will automatically include this. Plus, there will be other insurance like own damage insurance, that is damage to our vehicle due to some accident, due to collision. Then there can be fire, similarly explosion, self-ignition, lightning, then burglary or theft, then loss or damage due to roids and strikes, earthquake, then other natural calamities like flood, typhoon, hurricane, storm, tempest, inundation, cyclone, hailstorm, frost. So damage to vehicle due to all these calamities is also covered. And of course, damage due to an accidental collision is covered in own damage. Now, terrorist activity has also been included in this comprehensive insurance. Sometimes it happens that a person gets transferred to another city, so he would normally hire a transport company to transport his vehicle from one place to another. So any damage in the transit period is also covered by this comprehensive policy. Otherwise, also manufacturers also transport their vehicles to different cities, so that transit insurance is also covered. Now, there are various categories of vehicles, as you know. For example, there are two categories. One is private vehicles, other are commercial vehicles. In private vehicles, we have our private cars of different makes and different models. Then we have our two-wheelers in the form of mopeds, scooters, motorcycles. Then in commercial vehicles are further divided into categories like passenger carrying vehicles. Again, in passenger carrying vehicles, there are different categorizations. Vehicles which are for passengers up to 6 people. Vehicles, they are called maxi cabs, more than 6 people but less than 12 passengers. Similarly, other passenger buses, more than 12 passengers. So we have different rating of premiums for different vehicles. Similarly, there are goods carrying vehicles. In goods carrying vehicles, previously insurance company used to have categorization like private carrier and public carrier. Public carrier were those vehicles which were owned by transport companies, and they used to carry goods of different organizations, different people. Private carriers, the truck or the vehicle owned by a company to transport its own goods. So there used to be different ratings of premium, but nowadays they are not distinguishing between them. So, and then there are other miscellaneous vehicles also, like there are cranes, there are dumpers, there are excavators. They also come under vehicles category. So, you know, we have different premium ratings for different kind of vehicles. There are in-house vehicles also, which fly in the factory area, carrying goods from one place to another. So insurance companies charge different rating from them because they don't move on road, so they have less risk. So according to the risk vulnerability, according to the risk exposure, different ratings are there. Then, as you know, that third party liability cover is compulsory for all kinds of vehicles, whether they're cranes or dumpers or excavators. And how do you decide about the value of a vehicle? If it is a new vehicle, if it is just out of a showroom, so then the manufacturer's price would be the insured value. So there is no doubt about that. But what happens when the vehicle gets older, say after 1 year? After 1 year, previously the concept in the market was that as per the market value of that particular vehicle. In that case also, suppose I have run my vehicle quite less and less kilometers, others have run it more. So how to decide about the value? Now insurers have come with a concept which is known as IDV, which is known as Insured Declared Value. The name says that the value would be declared by the insured, but now for most of the, for example, for most of the private vehicles, insurance companies have got fixed rating. Let's say any vehicle which is going to be insured, say for, you can say vehicle not exceeding 6 months. Vehicles which is 6 months old, you can say. Up to 6 months, you can say depreciation of 5% would be there. So less manufactured price 5%. So that will be the IDV. Then exceeding 6 months, but not exceeding, or you can say but up to 1 year, it will be 15%, sorry. So less, the current price 15% less would be the IDV. So without any doubt, so all insurance companies, today in India there are 15 general insurance companies, so all will follow the same pattern. So there will be no anomalies, there will be no controversies. Similarly, exceeding 1 year up to 2 years, it would be 20%. Similarly, exceeding 2 years but up to 3 years, it would be 30%. Similarly, exceeding 3 years up to 4 years, less 40% manufacturer's price. Similarly, exceeding 4 years up to 5 years, 50%. Now, any vehicle beyond 5 years, that will depend on the market price of the vehicle, the condition of the vehicle, and it would be on mutual consent of the insurer as well as the insured person. But up till 5 years, this would be the pattern of calculating the price of the vehicle. Many times, in the case of own damage, many times damage takes place due to some collisions. So a surveyor has to be deputed by the insurance company who is an automobile expert, and he or she assesses the loss, and in case of any replacement of the part, either he will approve the repair of the part, denting, painting, and apart from them certain parts have to be replaced. So for that there is a different, you can say, depreciation chart. So there, not exceeding 6 months for claim purpose, you can say. This is for IDV. Up to 6 months, no depreciation would be deducted. Nil for claims. Here it would be 5% up to 1 year. 5% depreciation would be deducted. 10%. Here it would be 20%, 30%, 40%. Now there has been a little bit changes by the Motor Vehicle Act. So previously it was like that, 20%, but now every surveyor used to deduct it on his own prerogative. But now this is 10, rather this is 15. Then this is 20. And this is 25 and 35. Then 5 year to up to 10 years, it is 40%. And exceeding 10 years, this is 50%. Now this is on metal parts, plastic parts. Whereas if there are rubber parts or fiberglass parts, then straight away the depreciation will be 50% irrespective of the age of the vehicle. Whereas on glass items there won't be any depreciation. If it's a windscreen glass, then it's irrespective of the age of the vehicle, whether it's 8 years or 10 years old, there will be no depreciation in claims. Then in the wound damage part of the vehicle, aging of the vehicle is not covered. It should be, the accident should be all of a sudden, it should be due to some external sources. Now, there is another topic in our syllabus which says motor vehicles, insurance and society. How? Because motor vehicles are run on roads, so therefore a large section of people are affected by this. There are several claims also. So what are those various sections which are affected by motor vehicles? Let us look at a case, a term which is known as hit and run accidents. Hit and run accidents are defined as those situations in which a vehicle has knocked down a certain person, and in spite of various measures, the identity of the vehicle or the identity of the driver was not able to be located. So the whereabouts of the vehicles are not known. So from where the victim will go to take a claim. If suppose a person has died because of an accident, because of collision, so that case is known as hit and run. The person has run away, the vehicle has run away. So where to take recourse? So for that, the government of India has come up with a fund which is known as Solatium Fund. Solatium Fund basically is financed by the government of India, by the central government, and central and state governments also finance it. Central and state governments contribute 30% to the fund, whereas the remaining 70% to the fund comes from the general insurance industry. All the general insurance companies, they contribute towards this fund up to 70%. So in the cases of hit and run accidents, in the case of death, 25,000 rupees is given to the victim's family in the case of death, whereas in the case of permanent disablement, 12,500 rupees are given. Now what happens in those cases in which the person's identity has been located? So in those cases there is another term which is known as no fault liability. The victim's family does not have to prove that the other person's negligence had caused this accident, or the other person, the driver, was at fault. So there is a concept called no fault liability, that is, there is a liability to pay the compensation. The driver is liable to pay the compensation, and insurance company on behalf of its insured person will pay the compensation on behalf of its person. So in this case, in no fault liability, government has fixed that in the case of death, 50,000 rupees would be given, and in the case of permanent disability, 45,000 would be given. Now, the interesting fact is that this is on the basis of no fault liability. Now, in case the fault has been established by the court, there are various courts also. There is a court called MACT, which is called Motor Accident Claim Tribunal, which decides on these accident claims. Similarly, there are other courts called Lok Adalat also, or Lok Ayukt. They decide these cases, and in case of fault liability, they fix a compensation of say 2 lakh. Then this no fault liability compensation, if it has been given, it will be deducted from this claim. So 1.5 lakh would be given. Sometimes it may happen. For example, the court has fixed on the basis of fault only rupees 40,000. But then no fault liability says 50,000, then it won't be taken from him. In case of excess amount, the excess amount would be given, less 50,000, but if it is less, then minimum 50,000 has to be given in the case of death. There are several other schemes introduced by the government of India. Some of them are known as Jal Rahat Yojana. So what is Jal Rahat Yojana? As the name indicates, it's to give a quick relief to the concerned party in case of death or permanent disability. So initially the subsidiaries of general insurance corporations had introduced this scheme to expedite payment of compensation to road accident victims. So for claiming compensation, the concerned person can directly approach the insurance companies, and there is a committee which is formed, which consists of members of MACT, members of Lok Adalat. MACT is headed by judges, mainly High Court judge, retired judges. Similarly, Lok Adalat are also headed by High Court judges and other district and sessions judges. So some of the representatives of these committees and other judges are members of Jal Rahat Yojana. Medical practitioners are also members, some advocates or solicitors who are expert in motor accident claims. They are also members of this scheme, just to expedite. So there are various schemes which try to expedite these claims. Okay, thank you.